Good morning, everyone. Welcome to today's Phillip Securities Research morning call. We have quite a few stock counter updates. For initiation, we have Everglory. For results, we have C Limited, Centurion, Soilbuild, Penn United, Sasseur REIT, China Aviation Oil, CNMC Goldmine, ComfortDelGro, PropNex, ST Engineering, Prime US REIT, Stoneweg European REIT, and Capital Land Investments, and CDL. For Phillip On The Ground, we have Yang Zijiang Finance and Nam Cheong. For update, we have Keppel. And we'll end off the session with the usual SG Weekly Week for 34. And today we also have the SG Banking Monthly. Kindly note that today Zane is on leave, so there wouldn't be any TA session at the end. Yep. This is the disclaimer slide. Kindly note that any contents presented is solely for educational purposes and not financial advice. Without further ado, I'll hand over the time now to Helena. Thanks.
Thank you, Igban. So I started ball rolling with C Limited, which released their earnings last week. So their second quarter revenue and PME were in line with expectation. Okay, move to the next slide, please. So revenue grew 39% year on year, which is primarily driven by their strengths in Shopee and Money, which they are financial on. So if we look at the first half 25 revenue and PME, they were at 48 and 46% of our FY25 estimate. PME especially grew 418% year on year. So which brings us to our first positive point. So the strong profitability is driven by Shopee. The adjusted EBITDA for the quarter reached $829.2 million US, which is nearly doubling from the second quarter last year. So for the e-commerce, their revenue grew 34% year on year. This is driven by their higher GMV, which grew 28% year on year. They're also trying to improve their take rate. So the take rate hit a quarterly record of 12.6%, which is up 50 BPS year on year. So advertising was actually their key contributor to the monetization for e-commerce. Because of a lot of the tech enhancement they have, it increases the active ad seller by 20% year on year and ad revenue per seller by 40% year on year. Advertisement take rate was raised 70 BPS to 2%. And management had indicated that they had planned to further increase their ad take rate because it's still considered pretty low. They have a long-term growth of around 4 to 5%. The second positive point is their growing financial arm. It's actually the fastest growth they have within the last 2 years. So Money, formerly known as C Money, its revenue climbed 70% year on year, with its loan book surge very much, 94% year on year. So this is driven by their initiative. They recently integrated the S Pay Later with Malaysia's national QR payment network, Do It Now. So that kind of enables the Malaysians to do more convenient daily transactions for their everyday purchase. And also they're introducing a higher credit limit for users who are willing to voluntarily provide their proof of income. So if you're able to prove that, even if you're not a regular user of Shopee, they're going to be able to raise the credit limit for you. So because of these two initiatives, they actually grown their loan book a lot. And we view this momentum as very healthy because even though they've grown their loan book at a really, really fast speed, their non-performing loan ratio actually even decreased from 1.1% last quarter to 1% now, because they're going to be able to leverage on Shopee's very rich data ecosystem to make sure that they collect enough data to know about the credibility of the people borrowing money from them. So overall, we project Money to grow around 40% year on year in FY25. Moving on to the negative, gaming has been doing really, really well. But this quarter onwards, the metrics are starting to slow down. We take a look at the revenue; it's still very healthy. It grew 28% year on year, but the revenue for gaming has always have a delayed effect. So it would be more accurate to look at their user matrix, which is the booking, the QAU, the QPU. So for their bookings, it grew 23% year on year. Compared to last quarter, it actually grew 50% year on year. QAU, QPU this quarter was 3% and 18% respectively, but the previous quarter it was 11% and 32%. So if you take a look at the numbers, the slowdown was quite significant. So this kind of suggests that the strong momentum that we see in the previous quarters, where they always have very consistent high QAU, QPU growth, is no longer sustained. And this is potentially due to because pandemic, there was a period when people actually get tired of playing game. Then they start slowly seeing the gamers coming back. So our guess is there's a normalization now in the player engagement. So like the increase is just not that obvious anymore. But we're going to be continue monitoring the metrics. But we think it's going to weigh on the bookings growth in the coming quarter unless they start releasing new games or they have certain content updates that can reignite the player activity. So moving on to outlook, they've guided that Shopee is going to continue the strong momentum now, and they also guided that for the gaming, especially Free Fire, the booking is going to be growing around 30% year on year. So overall, we think C still presents a compelling long-term growth opportunity. Shopee continues to lead regionally, and money they're rapidly expanding its digital lending footprint. So for their gaming, Free Fire is still remaining as the top mobile game globally. We do see significant slowdown now, but we're going to continue monitoring for the next few quarters to see whether there's actually a significant slowdown in the momentum. But overall, we've seen the integrated ecosystem has been supporting their consistent revenue and they're driving their profitability up by a lot. But however, in the short term, after a significant rally since the beginning of 2025, the stock now trades at a forward FY25 PE ratio of 52x, which if you compare with the industry average around 30x, that's considered pretty high. So we do see limited upside at this valuation. So moving on to our recommendation, we maintain our neutral recommendation. We raised our FY25 revenue and PAMI by 1% and 9% to reflect growth in Money and Shopee, as well as their improvement in the take rates. We raised our DCF target price from $160 to $170. Yeah, so that's all from my presentation. I'll pass my time to Iben.
Thanks, Helena. Yep, so I'll be presenting on Everglory's initiation. Yep, so Everglory is a Singapore-based M&E company. Their core capabilities is to do air conditioning and plumbing, electrical and fire prevention services. And also they have this category called integrated building services where they can integrate all these capabilities into a project. Yeah, so for Everglory, they are more than 85% of their projects come from the private sector, and most of these projects last 1 to 3 years. Yeah, as you can see in the table, I think the most notable contract value is the 21.8 million contract, which they have done the aircon, the electrical works, the fire protection system, and plumbing works for the PSA maintenance space. And currently, their ongoing projects they are also working on the M&E contracts for the projects listed in the bottom right-hand corner, as you can see, iQuest, Heart of Beauty, and the private condominium, Lentor Modern. Yep. Recently, they have completed the acquisition of Guthrie Engineering. So Guthrie is also a Singapore-based M&E company with a very long track record established since 1951. So Everglory acquired Guthrie for a total of $46 million and is payable for 3 tranches till next year. Currently, Guthrie's order book stands at $312 million, and this is 4 times Everglory's last year's revenue. So as you can see in the revenue chart at the bottom, we do think that this $312 million order book will be able to boost Everglory's revenue growth by about 29% CAGR. Because we estimate all these projects to be completed within the next 2 to 3 years. And as for profits wise, we do think that this year's net profit margin will fall by about 1.2 percentage points, and profits will remain roughly flat because there will be some costs involved in the consolidation of Guthrie. However, we do think that it will normalize to about 10 to 11% levels because bigger projects will mean that Everglory will be able to more efficiently deploy its resources to these bigger projects. And I think one special capability of Guthrie is they are able to take on key landmark projects, for example, aircon in Jewel and also runway lightings in the airport lights. Yeah, so these gives Everglory a, a, a bigger diversity of higher value projects to bid for. For example, with the Terminal 5 upcoming, Everglory will also be bidding for the Terminal 5 runway lights. And there are also many hospital contracts upcoming, so which is also the additional kind of projects which Everglory can bid for now. As for Everglory's balance sheet and cash flow, their average current ratio for the past 5 years has been 1.4, which means they have higher current asset and current liabilities, which is healthy. They turned net cash of $2.9 million in FY23, and free cash flow also increased by 57% year on year to $9.2 million in FY24. So we do think that this positions Everglory in a much better place to raise cash and pay for Guthrie's acquisition. As for the industry trend, the private contracts awarded increased by 68% in May. This shows that there's strong demand for private contracts in Singapore. And this is being driven by the 360% year-on-year increase in private institutional projects like hospital tenders. Yeah, so each hospital tender will be roughly 100 plus to 200 plus million. So we do think that this will, with Everglory bidding for these hospital tenders, it will greatly boost their order book. And because all these private contracts you see in this graph are first awarded to main contractors first. After that, the main contractors will tender these projects to M&E contractors like Everglory. So we do think that Everglory will stand to benefit from this increased trend in private contracts. Now, looking at Everglory's valuations, currently they are still considered quite undervalued. If you look at the historical PE, they are trading at a PE of 16 times, which is a 54% discount compared to their peers' average PE of about 35 times. Our investment thesis for Everglory is that for their own organic growth itself, there is favorable tender opportunities. For example, they can bid for schools, hotels, mixed-use developments, and industrial facilities. As for our second investment thesis, we do think that the acquisition of Guthrie allows them to bid for higher value projects in the future. For example, the Changi Airport Terminal 5, the community hospital projects, industrial estates, as well as the IR projects. And Everglory has been achieving high net margins of average 10.8% for the past 3 years. So this is much higher than a typical construction company in Singapore with net margins of about low to mid single digit. So this is the nature of M&E contracts generally. Yeah, so it's also good for Everglory in terms of PATMI growth. Yeah, so we initiate coverage on Everglory with a buy rating, target price 0.81. The target price is based on 18 times blended FY26 to 27 PE, which is a 14% discount to its peers forward PE of 21 times because there may be some M&A merger risk from Guthrie itself. Yeah, so moving on, I'll be presenting on Centurion's first half results. Yeah, first half revenue and PATMI is within our expectations because both worker and student accommodations experience positive rental revisions. So for the positives point, we do think that there is still room for positive rental revisions because first of all, the huge construction projects in Singapore has not really kickstarted. For example, the Changi Airport Terminal 5 community hospital and IR projects. So we do think that there will still be very strong demand for worker accommodation bids. And as for their student accommodation segment, there's a 32% increase in UK student visa applications, most recently in the first quarter this year. And Australia has also increased their foreign student cap by 9% at the start of this year. So the demand supply dynamics in UK and Australia for the student accommodation bids is still very healthy. And we do think that there is still room for positive rental revisions. And the occupancy rates are still high. For worker accommodation, it is still at 99%, which is the maximum already. Not possible to hit 100%. As for student accommodations, for UK and Australia is 97% and 91% respectively. Yeah, so it's still above the 90% range, which is still considered healthy. As for their negative, their PATMI declined because of fair value reductions. However, if you strip out the fair value reductions, the adjusted PATMI increased by 19% year on year. We don't think that this drop in PATMI has a significant impact on Centurion because they recently spun off their REIT assets. So a lot of these uh, uh, fair value fluctuations are being locked in by the spin-off of their REIT because most of the assets are in the REIT itself. Yeah, so going to the bottom left-hand corner, we recently had a site visit to Westlake OB, which is Centurion's new 1,650 bed worker accommodations. So as you can see, this worker accommodations is very new. It is compliant to the new dormitory standards set up by MOM for 2040. So some of these terms include, for example, between beds there should be a 1 meter gap, and also within a room itself there should be ensuite toilet, and there is a maximum of 12 workers in each room. Yeah, so all these regulations come up after COVID because the government wants to contain sort of the spread of infectious diseases. Yeah, so this Westlake UB is the first dormitory in Singapore to be compliant to these new dormitory standards. And as you can see, there's also quite nice facilities for the workers. For example, the gym, the table tennis tables itself. Yeah, so moving on to our call for Centurion, we maintain accumulate. We raise our target price slightly to 2.01 because we raise our revenue and adjusted PATMI slightly to reflect the strength in the first half results. And we also adjust our model assumptions to exclude. Previously, we had a debt assumptions in the parent group's ownership in the REIT itself. But however, we adjusted our assumptions and we removed the debt assumptions. That's why we are able to increase the target price. Yeah. Moving on to Soilbuild's results. Yeah, so for Soilbuild's first half results, their revenue and PATMI exceeded our expectations. And this is because they have completed several key projects. For example, some of these projects include the more than 100 million DB Schenker logistics facilities, the Toa Payoh HDB project, which is worth about 140 million. Yeah, so all these completion of key projects drove the revenue and PATMI. And currently their order book stands at $1.19 billion. So it is still being maintained from last year's figure, as you can see in the table below the red color box. Yeah, so as for the positive for Soilbuild itself, their construction and precast segment operating margins increased by 5 percentage points year on year. This is because the key projects which they undertook is very large, so they are able to increase the operating efficiency by deploying the resources more efficiently. So this lowers their cost of, their costs. Yeah, and because of this PATMI growth, their balance sheet is also being strengthened. They generated 47 million of net cash in this half itself, and as a result, the net debt decreased by 92% to 3.4 million. So currently, they only have a net debt of 3.4 million, so which is very healthy. As for negative, for Soilbuild itself, yeah. Oh, sorry. I think there's a mistake over here. But for negative, we don't view Soilbuild to have any negative in this first half results. Our call for Soilbuild is to upgrade to buy from accumulate because we raise our target price to 2.68. And that's because we raise our revenue and PATMI assumptions because of the order book visibility. As you can see, in the chart in the bottom left-hand corner, the private industrial contracts awarded has increased 60% most recently in June. So there is still strong demand for private industrial contracts, and Soilbuild is actively tendering for more projects in the second half of this year itself. We do think that they are able to win further contracts in the second half because they have capability in their BIM modeling, which is their video rendering capabilities when they put up tenders. So this is in contrast to artist impression being put up by competitors. So it increases their chances of winning tenders. And as for our call, we also raised our valuations to 5.9 times PE. Previously, it was 3.6 times because this is more in line with the historical PE from the past 3 years. Yep. Okay, moving on to Pan United's results. Yeah, so their first half revenue and PATMI is within our expectations. Positive for Pan United is that they managed to achieve higher margins being driven by recent investments. So their recent investments include their upstream facility in Johor itself. So this facility started producing carbon mineralized concrete for Pan United's in-house usage. So after scaling up the facility itself, they are able to derive lower costs. So if you can see their gross margins on the left itself in the table, it managed to increase 2.8 percentage points. And they are able to achieve higher efficiency from their technological investments being made. So one example would be the image that you can see at the bottom of this slide. So they operate a central command center to optimize their operations. So one example would be their truck fleet and queue duration. So with investments in technology, they are able to streamline the operations more efficiently, and this reduces for example, their truck queuing times, and thus enables them to lower their costs. For the negative for Pan United, there is a jump in capex and depreciation expenses by 20% in this half itself, because of the new Jurong Port facility. Yeah, so Singapore government wants to consolidate all these building material sites into a central location to reduce truck trips. And we do think that overall this is a positive for Pan United because even though there's a short term, there's a jump in capex and depreciation expenses, over the long term, it will raise the barrier of entry to competitors, because their competitors will also have to fork up a high capex in order to join in this building material scene itself. For Pan United, we maintain a buy. We raised our target price to 1.34. We maintain our revenue and PATMI forecast, but we raised our working capital assumptions by 32% because in this half itself, Pan United actually had a $6.2 million increase in inventory sold. So this increases their cash flow from operations. And we also lower our beta and WACC from 11% to 7.7% from the improved visibility of contracts being secured. So recently they announced that they secured $430 million worth of contract from Changi Airport Terminal 5. And this is the first time in recent history that they announced this kind of contract wins. And this $430 million of worth of contract, it will last for the next 5 years. So if you analyze it per year, it will bring a revenue boost of about 10% more for Soilbuild. And for this year itself, based on BCA forecast, as you can see in the chart in the bottom left-hand corner, BCA did forecast about a 3% increase in ready-mix concrete volume demand. So this is also positive for Pan United itself. Yeah, so I think that's all from my end. I'll hand over the time now to Miao. Thanks.
Thanks, Evan. So Sasseur REIT released the first half result last week, and results was within our expectation. DPU declined by 3.1% year-on-year, mainly due to weaker RMB and also capital retention for debt repayment. And something positive about Sasseur is their finance costs fall by 4.8% year-on-year, as cost of debt declined by 50 basis points to 4.8%, which was driven by increased portion of the RMB denominated loan. Currently, they hold 90%, which is 90% of the total debt. And compared to first half 25, which was 70%, increased by 20 percentage point. With the declining LPR, we do expect some like potential acquisition and also declining cost of debt to decline further, probably will decline to 4.5% in FY25. And with sensitive analysis, a 50 basis point reduction will translate into 0.2 cents on DPU increment. And other sales also rebounded in second half 25, with Chongqing Liangjiang rising 7% year-on-year, supported by double-digit growth from the May Labor Day holiday sales. However, Hefei Mall was still the weak point. If performance fall by 5.3% year-on-year, mainly impacted by intensified competition from the competitors, which they were launching more promotional events, as well as like some disruption of footfall due to ongoing tenant mix and tenant rebalancing. Yeah, but we do expect a stronger second half 25 performance, driven by large scale promotional events such as the mid-year sales, anniversary sales, and also year-end sales. And for negatives, RMB continued to be the main drag, as it depreciated by around 4% against Singapore dollar in first half 25. And the market remained bearish on the outlook, given the highlighted trade tension and also muted domestic macroeconomic outlook. Yeah, which we expect this to have a direct negative impact on both NAV and DPU. And for outlook, we do expect some form of acquisition this year, since LPR is on the declining trend. Yeah, so the target will probably be the third-party outlet, which the sponsor hold ROFR agreement, and we do anticipate a NPI yield of 7% for the acquisition target, and they are mainly funding through banks or sponsor loan with no EFR plan. And Sasseur also expect year-end valuation to remain stable. Even with like shorter land tenure, they still expect stable valuation with support from the robust operating metrics such as sales outlook. We do maintain a buy recommendation with unchanged DEM TP of $0.78 with no adjustment for our financial forecast. And Sasseur is trading at FY25 dividend yield of 8.7% and a price to NAV of 0.85 times. Yeah, next slide, please. Yeah, so moving on to China Aviation Oil. First half 25 result was outperform our expectation, accounts for 60% of our full year estimate. Yeah, despite we already expected a seasonally stronger first half 25. So PATMI surged by 18.4% year-on-year, and total profit rose by 25.7% year-on-year, driven by higher profit from jet fuel supply business, supported by increased volume and also higher optimization gain from trading activities. And CL is also capitalizing on China's oversupply of jet fuel. Yeah, so they are taking a spread by purchasing at a lower price in China and resell at a higher price to Europe and also rest of the Asia countries. And gross profit margin also improved marginally by 0.03 percentage point to 0.35%, which is supported by the increasing soft trading volumes. Even though it only accounts for like low single digit of the total trading volume. Yeah, but we still expect like margin to expand further in second half 25. Since the margin for SAF is usually like 3 to 5 times higher than the conventional jet fuel. And there's also increasing contribution from Shanghai Pudong International Airport, which is their associates. Yeah, so profit from associates surged by 18.6% year-on-year, driven by higher refueling volume from Shanghai Pudong International Airport, which increased by 13.9% year-on-year. Yeah, so the number of flights handled at Shanghai Pudong International Airport already exceeded pre-COVID level by 5%, and with international visitors' arrival surging 29% year-on-year in June 25. And we do foresee further growth from second half 25 onwards, due to increasing inbound demand as RMB continue to depreciate against major global currencies like US dollar and also pound. So we do expect like full year contribution from Shanghai Pudong International Airport to reach 15 million, which is 77% of the FY19 level, and contributing to around 60% of the group's total PATMI. And for outlook, we believe coupled with robust contribution from associates, tailwind from the core trading business, and a strong cash position of 515 million, this would be an opportune time for CAO to return some of the value back to its shareholder through like either special dividend or increase their dividend payout ratio. Yeah, so just a quick recap, dividend payout ratio was 40% last year. Yeah, so we do expect some increase this year. Yeah, especially with like the state government is encouraging SOEs to raise their dividend. Yeah, so we upgrade sale from accumulate to buy with a higher DCF TP of $1.5, supporting by the strong jet fuel demand and also higher associates contribution. And CAO remain net cash position of 550 million, which is around like 66% of the total market cap. Yeah, and that's all for CAO. Next slide, please. Yeah, moving on to CNMC result. They deliver a very strong first half result. Yeah, so PATMI beat our estimate from 86% of our full year estimate. So it rose by 251% year-on-year. Yeah, so they had like record profit driven by a 41% increase in average selling price of gold and also 26% year-on-year increase in sales volume. And with the record profit, CNMC announced an interim dividend of 1.5 cents, which include a special dividend of 1.1 cents. So overall, it represents a payout ratio of around 30%. So something positive is they do have resilient operating leverage. So operating margin in first half surged by 22.8 percentage point to 48.5%, as the gold production grew by 26% year-on-year. So all-in costs rose only marginally by 6.1% year-on-year. Yeah, still like remain below the 26% year-on-year production growth, which is reflecting substantial operating leverages. With the surge in production, CMC also benefited from the economies of scales. So several fixed costs such as set and factory expense, rental and lease expense decline as a percentage of revenue. So net profit margin nearly doubled to 36.8% in first half 25. And we do expect EBITDA margin to expand further. And so on a full year basis, it will expand by 8.4 percentage point to around 45.6%. Yeah, according to our estimate. Additionally, we also foresee sales revenue from gold to increase in line. So second half 25 gold production to match the first half 25 level with potential like uncertainties from the all grade variations, which could affect like recovery rates. However, CMC is trying to mitigate this by blending the grade to maintain the consistency. Yeah, so further upside is expected to come from the CLI facility, which is set to expand production capacity from like 500 ton to 800 ton, which representing a 60% increase. And we also expect revenue from non-gold metals, including like that lead, silver, and zinc, to surge 77%, to surge by around at least 50% in FY25, which contribute to 30% of the overall revenue in FY25. So in first half 25, revenue from non-gold metals surged by 77% year-on-year, mainly driven by a 50% increase in their sales volume and a 22% increase in their average selling price. And for outlook, we're aware of the seasonality involving the business, as the Euro business is usually will usually face some downtime during monsoon period, which is from like mid-November to end of January. However, CMC do keep some stockpile for 2 weeks to buffer against like potential downtime caused by the rain. And they're also constructing a second underground mining facility at Suku to assess better ore grade. Yeah, however, the project is currently we foresee some like delay in the project due to the underground water issue, but they do have like sufficient experience in handle such issue. So we expect the project to be completed by first half 26. And we maintain buy with a higher DCF back target price of $0.7. And CMC is trading at F125 PE of 7.8 times, despite a rally in their share price of 150% year to date. Yeah, so next slide, please. Yeah, that's all for CMC. Yeah, moving on to Yangzijiang financials. This is a Phillip on the ground. Yeah, we don't cover Yangzijiang financials. So yeah, they currently yeah, Yangzijiang, sorry, there's a typo on the slide. It should be Yangzijiang financials, and their market cap is 3.69 billion. And for first half revenue, even though like revenue dipped by 23% year on year, their PATMI still grow by 28% year on year due to a 13 million reversal of allowances. Yeah, notably, income from maritime investment increased by 82% year on year, and they're trying to spin off this part of the asset. And for AUM, we actually see a slight dip in SGD denominated term. This is due to depreciation of both US dollar and RMB against Singapore dollar. Yeah, so China still accounts for 47% of the total AUM, of which debt investment accounts for 29%. And Yangzijiang is trying to lower their debt investment exposure. However, they do see like non-performing loan ratio to creep up a bit by 1.1 percentage point to 48%. This is mainly due to the shrinking in fund size. And yeah, so the non-performing debt will continue to facing difficulty to get the repayment. Yeah, so with the shrinking in fund size, they do foresee further increase in NPL moving forward. And they're also trying to expanding Singapore side exposure by repatriating some of the fund back from China. However, Yangzijiang Financials is still waiting for regulatory approval for the rebate of withholding tax, which is around 5%. And for outlook, Yangzijiang Financial is planning to spin off their maritime investment fund from their Yangzijiang Financial core businesses. Yeah, so the new entity will be Yangzijiang Maritime Investment and Development. Yeah, which like is consists of both investment and development. And Yangzijiang Financial side will remain focusing on their debt investment and also investment from like Singapore to Southeast Asia through the form of private equity. Yeah, and the new spin-off will be in the form of rights issue instead of like a IPO like last time when Yangzijiang Financial was spin off from Yangzijiang Shipbuilding. Yeah, so which means existing shareholders will be auto credit with the equal number of shares. Yeah, from Yangzijiang Financial, essentially like one share become two share, and the value will be split equally. Yeah, and they are also considering a private placement before spin off, with the purpose of like enlarging their shareholding base, so to attract like new shareholders, which will mainly be like institutional investors, and they are considering a 5% discount, to raise like 200 million shares. Yeah, but this is like yet to be finalized. It's only an initial like idea. Yeah, so this will like demonstrate their ability to attract new investors given that they have a profile of a Chinese company. And at the meantime, Yangzijiang Financial is still committed to dividend payout of 40%. And given the recent share price rally, they are trading at price to book a PB of 0.95 times. Yeah, next slide, please. Moving on to Nanchong, this is also a Phillip On The Ground. We don't cover Nanchong. Yeah, so there's no target price. And their first half result appear to be a mix. So even though bottom line dropped by 11% year-on-year, mainly due to lower vessel utilization, they are still like since they are preparing for usage of like long-term charters, but gross margin still up by 4 percentage point to 51%, mainly due to lower vessel maintenance expenditure. As a result, their core profit up by 1% year-on-year to 80.4 million. They currently host like 38 vessels, and Nanchong plans to keep 30% for the short-term usage and 70% for the long-term to secure the long-term contract. So this is reflecting their market view, like they believe there's still upside for the charter rate. And that's why they're keeping 30% to capture the upside, and 70% will be having like good earning visibility. And Nanchong is also actively reducing their gearing. So they made 60 million repayment, debt repayment, which is beyond the obligation of 20 to 30 million. So gearing stood at 0.57 times as of first half 25. And for outlook, they do believe offshore like a vessel or OSV will face like supply set constraint due to aging fleet and also like limited yacht capacity and limited financing abilities from the banks. So given like Nanchong's vessel is Nanchong's fleet has a relatively young age compared to the market, so they have like a better position to secure the long-term contract. So for the day rate for long-term contract is usually higher than the short-term contract. Yeah, and the group is still committed to their like geographic diversification strategy to Middle East and also Thailand. Yeah, so by far they deployed like one vessel to Middle East, even with like lower margin compared to their Sarawak premium they are having in Malaysia. Yeah, they are still like committed to the diversification strategy since they are able to operate at 360 days in Middle East. Essentially, there's no downtime in Middle East compared to Malaysia, since like Middle East doesn't really have like impact from like monsoon season. Yeah, so they do anticipate utilization in the second half to increase further from the 70% in second quarter 25. Yeah, so outlook is pretty positive for Nanchong. Yeah, so that's all for me. I'll hand over to Paul. Yeah, thank you.
Yeah, thanks, Mel. Yeah. Okay, apologies for the audio and because I'm overseas. So Glenn is on long leave, so let me just run through the Singapore Banking Monthly. So for Singapore Banking Monthly, this is a summary of the 3 banks' results. The highlight is really if you look at the PATMI, only DBS grew, and the main reason why DBS grew, if we focus on NII, which is net interest income, so DBS is the only bank that actually managed to grow their net interest income. One of the reasons is because they took in a lot of deposits and they managed to park their deposits longer dated bonds. So basically, they managed to put a lot of the deposits into fixed income securities, whereas the other 2 banks didn't. So that locked in those high interest rates compared to the rest. The rest of the parts were the same. The DBS yield is around 6.2%. I will just talk about it more later on. Next slide. So the other part is the interest rates. So the chart on the left, if you look at the very top, so that's the Fed funds rate. Although everyone is focused on US rates, but you notice Singapore rates, Hong Kong interest rates are all collapsed, almost down 50%. I think we mentioned before. So that is of course putting pressure on bank NIMs, but of course at the same time benefiting the property and also helping the REITs market. Next slide. So one thing positive for Singapore banks is the loans growth. I think it's also positive for the Singapore economy, but loans growth continues to pick up pace. It's about 6% in June, but year to date is 5%, so it's actually accelerating. You see loans growth from business and consumer, and with the robust property market, I think consumer loans should be able to pick up even more. Next slide. The other part that's helping the banks is a jump in deposits. So that's one thing which DBS mentioned. Even though the NIMs might be slowing down, they are getting a huge inflow for deposits. You can't see DBS proportion here, but they are probably getting a larger share than the rest. And because of that, even though the NIMs, which is net interest margins, can be lower, because they take the money not to lend out, but they can take the money and park it into government securities and earn like a 1% additional yield. And that yield is almost like free money in a sense, because they don't have to take up capital. There's no risk because they're just buying Singapore government bonds, and then you can get the 1% yield pickup. So that was the message they wanted to pass through. Even though NIMs might be coming down, but they will be enjoying higher volumes from the surge in deposits. Next slide. This is I guess a good chart for brokers and of course the SGX. So the one on the top, July, means the SDAV, as we all know, stock market volume, and DDAV is the derivative volume. So both are actually very strong, and of course both positive for SGX and the brokers. Next slide. So in terms of the final slide for Glenn's Banking Monthly is the bank performance. So DBS was the best performer at 6% for last month. One of the reasons DBS did well is because during the results briefing, which may not be apparent for some, because we do still get questions, they actually on paper raised their dividends for 2026 by 24 cents, which is 6 cents per quarter. So actually they're really guiding for 2026 a jump in the dividends. So that's what's helping. So their yield right now is about 6%. So I think that's what one of the difference why the performance was much stronger than OCBC and UOB, whereby their dividends still depend on earnings because they are still depending on the percentage payout ratio. Next slide. Nothing much. This is just the valuations, but yeah, the price to book, it looks elevated, but at the same time, when you're paying 6% dividend yield, it's hard for the banks to come down. The dividend yield kind of protects the share price, because otherwise the yield will be going to 7-8%. Which I think most investors will come back in if the yield is too high. Next slide. Now move on to Keppel Limited. Ring come collect your cash. So basically, this is about Keppel selling M1. So the most speculated sale to StarHub didn't happen. Instead, they sold to Simba. So actually, Keppel is just selling their consumer business, not the enterprise business. Of M1's enterprise business. So there's a lot of talk about how much they lost and all that, but so they will lose 200 million. Some investors might view this negatively, but I think we have to face the reality. For us, that we are positive of the sale because as we know, mobile competition in Singapore is actually getting worse. It's extremely competitive. Even a telco told me $10 price plan is just too expensive. So anyway, mobile prices are collapsing. So and if they were to continue holding the M1 stake, it will be very capex heavy. They still have to pay the 700 megahertz license, and it would have been a drag on group earnings. So for us, we view this positively. We did move our valuations a little bit because we added back this cash, and then we kind of adjusted the connectivity earnings, the sum of the parts. So it will still be incrementally positive. So for Keppel, they still keep the enterprise business because the whole game plan or strategy, if you want to call it, for them is to deliver the whole value chain for data centers. So if there's a data center, as data centers grow in Singapore and to the region, they want to deliver the power, the connectivity, which is a submarine cable, operations, they can run the data center, capital, they can fund the construction of a new data center without using their balance sheet. Of course, they will inject a little bit of money inside into the fund. And asset management, they can manage the whole assets, which is after you inject the money, I still manage the money for you and also collect some fee from you. So this whole value chain is what Keppel is after, and this sale just cleans up that part of it because they don't actually need to own a mobile consumer business. Next slide. Move on to Keppel. So I'm sorry for Comfort. So the first half results was released. UK is the part that shines again for them. Next slide, and will continue to be. So the revenue was within, but the net profit was below, mainly because after acquisition, they had to do amortization of the intangibles. So this number, most of us wouldn't incorporate because we do not know, because they, after acquisition, they have to negotiate, or at least I'll call it discuss with the auditors to decide how much intangibles, then they have to amortize. So we had to incorporate it. So that's why we lowered our forecast. The positive is UK. So if you look on the table on the left, sorry if it's a bit small, but you notice there's a big jump in earnings, almost 256%. If you remove the acquisition, the earnings were still had doubled from 9 million last year. The two reasons is because the Metro Line London. So this is a story the last few quarters. So in London, a few years ago, pre-pandemic, the margins there was like maybe 2 or 3%. It was a very brutal market because there was a lot of irrational competition. So right now, the competitors have left, most of them. So they are negotiating towards almost mid-teens type of margins. So that's why you'll notice and these are over the 7-year period. So they will notice at least the next 2 to 3 years, the UK will continue to be a big growth driver for them because they negotiate for higher margins, the Metro Line London, all the various bus routes that come due. The negative was when you acquire, you actually, of course, there'll be additional interest expense and capex. You notice a big jump in their interest expense. Sorry, it's not shaded, but it's a 76% jump. Partly, of course, there's FX there, but partly too is because when they secured the Manchester bus routes, so they won this contract. Part of the contract, of course, to win this contract, the competitive edge is that you must have the balance sheet. So they have to buy buses, 174 million of EV buses. Of course, all this they will get compensation back through the bus charges that they will charge the Manchester Metro line. But at the same time, they have to spend this capex. So the upfront, you have to take on all this, but all this they will get the cost recovery from it. We lower our earnings with amortization. No change in our target price. We lower to buy to accumulate because of the share price performance. The growth driver is again the Metro Line renegotiation. It's only half completed. CMAC. So CMAC is transportation during disruption. So it's very seasonal. So second half you definitely third quarter will be the peak. So you won't get that boost in the first half. Then the Metro Line Manchester, like I mentioned, that is secured, you will contribute second half onwards. But modestly, then the big jump will be 2026. 2026 should also benefit from the Stockholm rail contract that they won, which is only operational end of this year. Next slide. I'll move on to PropNex. So record revenue and earnings. Next slide. So for PropNex, the earnings was above our expectations, about 75% of our full year. So what helped them was the massive boost in new home sales. So you look on the left, project marketing, they call it project marketing, but actually it's new home sales. So you can see the earnings there, I mean, triple, or almost triple, 183%. The other positive was resale was surprisingly performing well, because if you look at the resale data, it's only up, I think 7-8% if I'm not mistaken, but they managed to grow their revenue at 66. So we think they're grabbing market share because the number of agents have searched for them. We raised our earnings by 32%, our target price to 202, and also I guess the share price really jumped a lot, but at that time was paying like 6% yield, supported by 140 million cash. Their ROE is some ridiculous number, it's like 60 over percent. Because in this business, it's not about the capital, it's about the amount of marketing effort that you make. Next slide. So in terms of, this is just some data that some of the forecasts that they're giving. So just for your reference, second half. So the key thing is everyone will be focused on is on the second half. So second half will still be strong because the momentum, they will recognize second half profit from the July and August sales. And of course, we know July and August, we just saw spring leaf sold 95%. So August will also be another good year, another good month. So second half will be strong. October, you won't see any sales. October is usually Hungry Ghost Festival. Then November will be the new launch again. But November, it will only 2026 earnings will only capture the November home sales. And then for private REITs, then for 2026, because of the huge amount of government land sales, that should help support 2026. Resale will also do well because what's happening is that their market shares. You look at the last bullet point. The one unknown into how much growth they can grow depends on the market share now. How much market share gains they can get, because they actually added almost 1,000 agents this year so far. So probably by the year end, will be more than 1,000, and this is 8% growth. So the growth that they're getting in agents is double that of the other three big agencies, which is ERA, Huttons, and slip my mind the other one. But anyway, Orange Tea, sorry. So their growth, the number of agents they're getting is double the other three big competitors. So how much market share will be the one that will be the big swing factor, I guess, in our forecast. Next slide. ST Engineering within expectations. So for ST Engineering within expectations actually isn't good because the expectation is high. So you need to actually beat expectation. But anyway, the results was within our expectation. The positive is they are growing the order book. So you look at the very bottom, the order book grew about 12%. The negative for them, just to recap again, for ST Engineering, there are three parts of the business. They got commercial aerospace, which is they will do maintenance of aircraft, passenger to freight conversion. That means you take the passenger airplane, convert it into a freighter for flying cargo, like for DHL, FedEx. And of course, they also manufacture engine parts, the nacelle engine parts. The negative was the second part of the business is of course defense and cybersecurity and IT, and the third one is satellite business and also urban solutions, which is basically setting up ERP and in other countries like New York and so forth. So the negative is the satellite business is still contracting because of Starlink Elon Musk's Starlink. So that's actually disrupting the whole market. And for them to recover, they need to. They are launching a new product, a new platform by September. So we have to see the outcome for that. We maintain our earnings, we maintain our target price. We downgrade to neutral because of the share price performance. Probably today is below the 820. But our near-term target, because the near-term valuations at that time 846, the valuations was like 31 times PE compared to the growth. So we just think that the share price might have overrun, although there's a lot of excitement over defense. But just a reminder, only 1/3 of the business is from defense. The rest is from aircraft and also satellite. Second half earnings will still be healthy because of the MRO, the whole defense ammunition sales, the 40mm, and the data center and also cybersecurity projects and so forth. And also they dispose of two assets which they will generate. I think 400 million, 400 million of proceeds, and that will also provide some interest savings. So second half will still be a strong half for them operationally. But again, it's just the expectations. The share price has, I think, jumped about 80% this year so far. Next slide. Okay, I hand it over to Darren. Thanks.
Yeah, thanks, Paul. I'll run through some of the results last week. Yeah, so first of all, Prime US REIT, they released the result. So for them, the DPU was down 33.3%. Distributed income was down 28.6%. But that's basically generally in line with our estimates because a lot of the leases that they signed the contribution will only start from the third quarter onwards and going to FY 2026 or so. So, but the silver lining here is that they managed to improve the occupancy, so that is a good start for them. Yeah, so for them, they had some strong leasing momentum in the first half. So we see 268,000 square foot of leases signed. So the big one was at the waterfront at Washingtonian. So that is the asset that's after it underwent some AEI. So, and that is also in a very challenging market, Washington. So Washington is one of the weaker markets in the US. So despite that, they managed to sign a long lease, 11-year lease. So that lifted the occupancy at that asset to 85.7%. So that asset is like the trophy asset in the region, or rather in the area. So that is also why one of the reasons why they managed to lift the occupancy. Yeah, but overall the portfolio occupancy improved this quarter to 80.2%. Yeah, the WALE is also increased to 4.7 years. So that is a strategy. They're trying to sign longer leases, so that gives them some stability. Yeah, and another positive for them this quarter is that they managed to get some positive rent reversions. So 3.4% in first half. So this compares favorably to one of their peers, like Manulife, for instance. They had some negative 10%. So this just shows that Prime US REIT, they are not compromising on rents to kind of boost up their occupancy levels. So it's really demand driven and flight to quality. So that is the demand for the rent for their space. Yeah, and for negatives, so far no. And for the outlook, they do have a strong balance sheet and their assets are high quality. So all of these will support the leasing momentum, because in the US market, like the capex requirements, that is borne, a lot of it is borne by the landlord. So to attract new tenants or strong tenants with long leases, they need to improve the asset, and then have some capex spending and like tenant incentives or free rent. So some of these terms are required to secure these larger tenants, which we believe Prime is able to provide these tenants. And physical occupancy currently is 70%, so that is relatively stable and probably increasing, as most companies now are mandating return to office already, at least 4 days a week. So we expect this to continue to improve, and ultimately will improve demand for office space. And yeah, like I mentioned, so this is the important factor, is that 10.5% of the occupancy that was signed over the past year or so. So we'll only start contributing cash rentals going forward from third quarter onwards. So as a result, we see right in the first half results, a lot of these committed occupancy has not started contributing. So as a result, the numbers are down. But once they start contributing, we expect this cash rentals to pick up. And as a result of that, we think it is possible that Prime US REIT can resume higher distribution payout. So now they're in the first half, they're paying 10% of their DI, so 10% payout ratio. But we are forecasting that to increase to 50% next year. So as of full year 2025, we still think it will be a 10%, and then 2026 onwards, meaning the first half 2026 will be a 50%. That's our current assumptions. So that brings the dividend yield next year to 8.25%. Currently, this year with 10% payout ratio will be at 1.5%. Yeah, so right now we slightly increase the target price on a slight recovery and lower cost of equity, but maintain our buy call. Yep, next slide, please. Yeah, so next we have Stoneweg European REIT. Yeah, so for Stoneweg, their first half results were in line with our expectations. So DPU was down. That's mainly from higher interest expense from the refinancing of the bond. So if you remember, at the start of the year, they refinanced the bond at higher rates, which because the previous bond was issued at when rates were basically zero or negative. So that is why when they refinanced the loan this time around, the interest spiked. But all these were within expectations and in line, so it's really expected. But for the MPI performance, if you exclude divestments and redevelopments that they have ongoing in their projects, or rather ongoing in their portfolio, the MPI will have grown 4.9%. Yeah, so for the first half, we saw some very strong positive rent reversions in the portfolio and a lot of leasing activity also. So we see the second quarter light industrial logistics, the rental reversions was very strong, 9.8%, office 17.5%. So the office reversions at so high 17.5%, that's because of the lease renewal at Hudson Port. So that saw a 52.2% uplift. So that one was from before the largest tenant, and it's for a long 20-year lease as well. So that is a very solid performance from that perspective. Yeah, and their portfolio generally is still under rented, so we still expect some positive rent reversions going forward. Yeah, light industrial and the office both is like 7% under rented roughly. So yeah, there is potential for higher rents. And for this quarter specifically, they started, or rather they invested into Ionics, a 6.72%. So if you remember, in June, they invested 50 million into this, the Ionics, which is the data center early stage development fund from the sponsor. So they invested this 50 million, and just a few days later, after they revalued the asset as they acquired another property. So after the revaluation, the 50 million stake has increased to almost 75 million. So that is almost like a 50% immediate gain from that, or immediate valuation uplift. So that is definitely NAV accretive. So going forward, we expect this 50 million to grow more and gain more valuation upside as the property gets built. Yeah, so there's a long-term, very high GDV going forward for these 5 assets. And yeah, for the portfolio, in just the 6 months, they saw some valuation uplift of 1.1%. So the logistics and light industrial portfolio was up 1.5%, and this time around, even the office was also up 2.6% from very strong leases signed, as well as about a 10 basis point cap rate compression. So going forward, we expect portfolio valuations to do well from further cap rate compression and strong rental reversions as well, and strong leases signed. So definitely Stoneweg, they are poised to benefit from more ECB rate cuts, and the sponsors pipeline for strategic acquisitions and inorganic growth. So one example was that Ionics fund that they invested in. So that's a very good example. And they continue to strive to divest non-core office in secondary locations. So we're expecting some divestments of these non-core offices in the second half of this year. And yeah, there are some measures that help to boost the demand for logistics and warehousing, such as Germany's fiscal easing to boost defense and infrastructure. And they do not have any refinancing requirements until next year. So we're expecting DPU to improve next year from stronger rents and very generally lower finance costs next year as well. Yeah, so no change to our TP, no change to our buy recommendation, and their Stoneweg, they're paying a very good yield of 8.5%. So that is despite the indicated DPU coming down. Yeah, so yeah, that's all for Stoneweg. Next slide, please. Yeah, so CLI, their first half 25 was very weak, mainly because of you can say sort of Trump's Liberation Day. Yeah, there were basically very little. The transaction market was muted basically. So we're expecting a stronger second half. So for their results were under our expectations. So that's mainly because of that, as well as a lower fund performance and transaction fees due to the absence of event-driven income. Yeah, so their REIB was relatively resilient despite the fact that they had some loss of divested assets in USA and China. So in my opinion, it performed better than expected. So if you strip off the deconsolidation of class, it will be declined by just 5%. Yeah, and yeah, so for the positives for them, the FRB recurring fees, so that is the recurring portion, not the event driven. So that remained very resilient in the first half. So if you combine all, it was up 5%. So the listed fund management, the lodging, commercial management, all grew by those by 6%, 4%, 1% respectively. The private funds valuation was down slightly. Yeah, and for the lodging business, they managed to open 4,000 more units, so that will continue to drive the lodging management growth. RevPAR is also up 5% in first half, so that is performing slightly better than the peers. The RevPAR is like more low single-digit growth, and the FUM for this quarter was unchanged. Yeah, but going forward, in the second half, we expect the acquisitions of the SCC Capital and Wingate as they start to fully contribute, so that will start to improve the PEMI numbers. Yeah, and yeah, like for the negatives, basically first half was very quiet. Slower decision making due to a lot of uncertainty. Which is why the event-driven fees dropped so much. Like we see under the REIT management, the event-driven fees fell from 7 million to 4 million. The private funds even worse, from 11 million, it fell to 2 million year on year. Yeah, so we are expecting this event-driven fees to pick up in second half. So backed by this lower interest rate environment. Yeah, and during this quarter, so they expanded their lodging business. So they signed 11 new signings, so across 50 properties, and they are expanding now into high demand resort destinations. Yeah, that seem to have a higher margins as well. Yeah, and for the first half, their balance sheet divestments were very muted. So we're expecting more divestments in the second half. So the key majority of these assets are from China. So some potential platforms that they can divest are the CLI RMB master fund, so that they could divest there in the nearer term, or in the longer term, as once a C-REIT get listed, yeah, they could divest there as well. So the C-REIT listing currently now is still on track to list by this year. Yeah, so with that, our buy call remains we maintain our buy call rather. Yeah, and no change to our TP as well. So we are expecting about 12 cents dividend. So that translates to about 4.4% for dividend yield. So we think that 12 cents can definitely be sustained by the recurring business alone. Yep. Next slide, please. Yeah. So next we have CDL. Yeah. So CDL, the title is all about the divestment train. So basically, we are expecting divestments to continue. So first half was very strong divestment wise, 1.5 billion. Yeah, so for their results, it was under our expectations, but that's really because of FX. So they had some unrealized FX losses of 63 million this quarter, or rather this half, versus a gain of 51 million last year. So there was a huge swing there. But if you exclude the FX, the PATMI would have surged by 300% to 154 million. Yeah, so the key driver was the property development segment. The sales were performed well, like the ORI performed well, as well as the full contribution of the EC Coupon Grant, which was fully sold in this half as well. Yeah, so 903 units were sold, total sales value 2.2 billion. So upcoming pipeline, they have Xeon Grand to be launched in the fourth quarter, and the Lakeside Drive GLI site that is scheduled for fourth quarter 2026 launch. They also managed to bid for another two GLI sites. So if awarded, you have more residential pipeline. Yeah, so the highlight for them this quarter was basically the ramping up of the pace of divestments. So 1.5 billion was contracted year to date, so including South Beach. So South Beach, they're expecting over 450 million in gains there. Yeah, so they have, other than that, they have contracted a lot of divestments that's not completed. So all these are expected to be completed by the second half, and we are expecting more divestments to come. So those that are basically not announced yet. So we think potential divestment targets could be those weaker performing assets in China. So we're expecting that if they are able to divest, probably will be at a discount. But it's we think it's positive, definitely positive for them if they can divest those China assets. The operating performance there is really not doing good at all. And yeah, some other potential divestment types, the UK land sites and some other mature assets in Singapore that has a limited upside potential. Yeah, so for the negatives, basically their gearing remains elevated this quarter, 70%. That's mainly because of the successful bids of the 3D GLS sites. So going forward with this divestment, the ramp up pace of divestments that could potentially be lowered when they use these proceeds to pay down debt. Yeah, and during this first half or so, they mentioned that they do have a longer term target of 500 hotels in the for the hospitality sector. So currently they have slightly over 160. So yeah, they're looking to expand that, and they think that is a very achievable target, expanding through management contracts and franchises as well. Yeah, and for Singapore, property market remains very resilient, as Paul mentioned earlier as well, with very high, strong take-up rates. And yeah, definitely capital recycling will be their key focus this year. And they declared a 3 cents interim dividend, special interim dividend this half, and we're expecting more special dividends as at the full year 2025 results, especially since they have some very good divestment gains and more divestment in the pipeline as well. Yeah, so with that, we maintain our buy call. We lower our RNAV discount to 35% or 45%, and we also readjust our RNAV. And as a result, the target price is now $8.34. Yeah. Yeah, so that's all for CDL. And exactly, I'll run through the weekly strategy. So our tactical views basically for this week was that last week we saw the CPI number, so it rose 2.7%. So that is below expectations, as tariffs basically had a modest effect. So as a result, we saw the expectations of a rate cut in September spiked. So now we are expecting, the market is expecting a rate cut in September and possibly in October as well. So we think this could likely signal the start of a easing interest rate cycle. So REITs are definitely the front runners to benefit from this lower interest rate cycle. And we saw the 3-month SORA fell, so fell over 50%. So 3.61 to 1.74% year on year. And as a result, we saw already in the first half from the REITs results, some of these REITs, they already saw some significantly lower cost of debt year on year. So the average all-in cost of debt, like from CDL, Hospitality Trust, ESR REIT, and KDC, it was down 0.6% year on year. So that is 0.6 percentage points year on year on the all-in cost of debt. So that is very significant. And from FEHT was down 0.9% because their hedge rate, interest rate hedge, fixed rate ratio was lower. Yeah, so basically for REITs, if your operating performance is stable, you just immediately get some DPU year-on-year upgrowth from these lower interest rates. Yeah, and another sector to benefit, earlier like Paul mentioned, so is property. Yeah, so the July sales numbers were out. So the new home sales were surged 3.5 times quarter on quarter to 940 units. So that is also 63% higher year on year. So the Lindenwoods was the top performer. So 96.5% sold at $2 at 2,463 PSF. Yeah, and during this July, so we saw CCR rebound with Robertson Opus and the upper house had some decent sales numbers, 41% and 53%. So that basically rebounded after the ABSD of 60% where absence of foreigners. So this CCR demand were from local buyers also. So there is a slight rebound in the CCR market. Yeah, and also Paul said earlier the PropNex record, and we expect because of these strong sales numbers, we expect the momentum to continue. Especially with these numbers likely to be in the PropNex numbers in the full year 2025. Yeah. Yeah, so for upcoming events calendar, a lot of results have been out already. So we have sets on 20 August, and we had the thing to watch out for is the 22nd August Jerome Powell speech. So to get a stance on interest rate cycle, whether start the easing cycle or not. So that is a key one. And also the FOMC minutes on 21st. And we do have some corporate insights webinars upcoming. So tomorrow we have Manulife, and the day after we have Takraw Corp. So both at 12 p.m. and after that SY Holdings and so on and so forth. Yeah. Typo. I just saw that there's a double Manulife. Yeah. Then that's upcoming corporate insights webinars. Yeah. So I think that's all. And remember to my colleagues for Q&A. Yeah. Thanks.
Hi. Yeah, I can take on some questions. So question, how rate sensitive is Centurion? Yeah, I think Centurion is quite rate sensitive because I think about 50 to 60% of their bank borrowings is under floating rates. So for their most recent half result, finance expense went up about 8%. But that is also because they have slightly increased their borrowings by about 5-6%. Yeah, so that's what caused the finance expense to go up a bit.
The
I think next
IPO
one is
the IPO is also rate sensitive.
yeah, regarding the REIT spin-off. Yeah. Next one is what are the breakdowns of Soilbuild's construction and precast business segment? Yeah, precast takes up about 22% in the first half results. Yeah, so the rest is construction, which is about 78%. Yeah. Yeah, I think just to iterate, there's no TA sharing tonight by Zane because he's on leave. Yeah. So question, Soilbuild 2.03 now, should I wait till pull back to buy? I think I will leave the CNMC here for Mel, but to comment on Soilbuild, yeah, I think our 1 year target price is still 2.6. So in the short term, I think it's harder to say. I think we'll need to wait for Zane to come back to comment more about the TA. Yeah. But over this half itself, we do see the potential catalyst being that they will still continue to tender for some private projects, for example, private industrial logistics facilities and potentially some data center projects also. Yeah. Let me see. AEM results was good, but how come share price didn't reflect on that? Yeah, I think in general there's it may come down to expectations, and also I think their guidance may not be very optimistic because they guided a midpoint revenue growth for the next half to be to decline about, I think, 10% year on year. Yeah, so I think they may be conservative on that, but I think shareholders may not react well to that. Yeah. Let me see. Yeah, I think for now, that's all for me. I'll hand over the time to my other colleagues. Thanks.
Thanks, Eben. I'll take down of the question. No, so which is a better accumulate, Yangzijiang Shipbuilding or Yangzijiang Financials? Yeah, so from a valuation perspective, Yangzijiang Financial is still trading at 0.95 times price to book. Yeah, so which is like has a slight discount to its net asset value, and they do have like catalyst of their spin off. Yeah, so and for the catalyst for Yangzijiang Financials is probably their maritime investment side, since profit up by 96%, 86% year on year, and leveraging on their like core capability of shipbuilding, they are able to negotiate the cost at a very low cost. Therefore they'll broke the ship at a better rate. And for Yangzijiang Shipbuilding, they did share that during Yangzijiang Financial, they did share that Yangzijiang Shipbuilding is took a more conservative approach in terms of like their revenue and profit recognition. So probably second half they do foresee like margin to expand further. Therefore, yeah, PATMI will also grow year on year. Yeah, but like that being said, we do believe like charter it already reached a peak of this like cycle. It's already at the peak of the cycle, and even though like ship owners are more optimistic about the USTR 301 issue. Yeah, the orders in the market are more of the small to mid-size orders, which Yangzijiang is trying to fill in is 2028 to 2029 delivery slot. Yeah, so the small to mid-size vessel tend to have a lower margin compared to the bigger one. Yeah, not to mention that they plan to shut down. They already planned to shut down the Runze project with the expectation that the new order win will be pretty muted. Yeah, hope it answers your question. And for CNMC, we did raise our target price to $0.7. So since they're selling gold at the spot rate, yeah, so it depends on the gold price in the second half. But production-wise, CNMC is confident that they can duplicate the first half performance. So production in the first half increased by 26% year on year. With the expansion in the CIL facility, the capacity is expected to increase by 60% year on year. Yeah, so we do believe they do have like the PATMI and revenue potential for CNMC, and the upside is expected to come from dividend. So in first half, the payout ratio is only around like 30%, and historically, they tend to distribute more given in a year of like strong financial performance. So last year, they distribute 40%. So we do believe like this year will probably be higher than 40%. Yeah, so if you annualize it, FY25 dividend will be more than 3 cents per share. Yeah, so we expect upside to mainly come from the dividend side. Yeah, hope it answers your question. And what's the probability of Yangzijiang giving free share for maritime spin off to existing shareholders at the ratio of 1:1? The same as Yangzijiang shipbuilding spin-off. Yeah, so if you recall previously, it was actually an IPO when they spin off Yangzijiang, and this time they try to use the form of private placement. Yeah, so it will be slightly different, but if you want to put it this way, it's not free share per se, like if, for example, their NAV is $1.2, they'll spin off into 2 entities. So each entity will be $0.6. Yeah, it's like a 1 share become 2 share, but not actually a free share. Yeah, per se. And yeah, hope it answered your question. Yeah, that's all for me. I'll hand over to the rest of my colleagues. Thank you.
Yeah, thanks, Mel. Let me just try to help answer some. What is the outlook on venture and target price? I think our target price is 11. We have a neutral call on venture. Do you expect any negative or positive impact on tariffs or semicon and healthcare sector? Yeah, so for venture, we discussed it last week, but essentially, the biggest problem for venture is this guy called Trump. So basically, because of Donald Trump, they got hit by a few ways. So because of Trump has cut back spending on research, so that affected ventures, life science equipment. Then Trump is cutting prices for big pharma. So that is also affecting ventures, healthcare equipment customers. Then Trump is also cutting funding on FDA, FDA. So that's also affecting their consumer lifestyle. They have a product, we believe it's IQOS, that's trying to get approval in the US. That could also be delayed. Yeah, so I think, so we're actually quite negative on venture for the second half. It is definitely a good I mean, they still make 200 million, they pay a good dividend yields. So there is no issue that just that we think earnings will still contract at least 9 to 10% in the second half. So 2026 could look better because we're still hoping that there is some new product coming up for the Philip Morris IQOS, and also they get the approval. If they get approval, then this stock will probably get there'll be a gap up in venture. I hope that helps the question, helps address the question. Your view on Keppel recent price falling since diversion of so I think disposal of Emma, I guess. The only negative I can gather is people are still harping about Keppel not making profits when they acquired M1. So for us, I think we don't really care because it depends on the reality on the ground now. You can always hold it and then hope the mobile competition kind of recovers. But mobile prices are not going to recover because they have two problems. Of course, it's not only just the competitors competing on themselves, but the big fat pool of profits that all the mobile operators used to enjoy, which is roaming. I think we all can see it for ourselves. Roaming, when we go overseas, roaming used to be probably the profit margin is 99.9%. But right now, competition is everywhere for roaming. You can get very cheap roaming, so that is hurting hurting the whole profitability for the whole mobile operator. And like we mentioned, if they were to keep holding on to M1, the value could actually come down because there is the 700 spectrum. You need to spend on capex and so forth. And yeah, so that's why we view the sale as positive, and we actually even increase our target price a little bit. Yeah. So I think that could be the one that's hurting the share price. Hi, can you provide some comments on SBS Transit and what are the chances of SBS Transit to win Tampines Bus package? Okay, because they lost the Jurong West package. So for us, I'm not too sure what is the edge right now for them, because if the competitor is willing to bid aggressively, whatever edge you have, it could be ironed out away. So the only positive I can see for SBS, so I'm not clear. I mean, to just answer the question, really not clear what is the advantage they have. And even if they do win, what is the cost? Because if there's a competitor willing to pull the margins down, the only upside we see for SBS Transit is that they will definitely they would very likely raise dividends because Comfort wants the cash. So because most of the cash is trapped at SBS Transit, so we think SBS will still pay very high dividends. But in terms of them winning the Tampines, very hard. Don't have a good answer for you. Yeah, because I don't, very hard to. It's about how low you want to go when you bid. So I'm not sure even if you win it, whether is it going to be a positive news. Any idea of the gains for Keppel from disposal of M1 stake? Will it result in special dividend or higher DPU for Keppel REIT? Yeah, there is no. They're going to record a loss. I think loss from the goodwill when they acquired. So the loss is about 200 million. So there'll be no special dividends from the disposal. I think yeah, and if you recall, Keppel has a $14 billion disposal target. So the M1 is not part of the disposal. So there's another 14 billion of assets they are going to sell, and that is excluding M1. You know. So if you include M1, it's probably 15 billion of assets that they will sell. What's the chance of ComfortDelGro promoted to the main STI category next month? I think Olam is ahead of them, if I'm not mistaken. Yeah, if I look at the because all these market cap changes change every day. CK. So I think it is still Olam ahead, but I need to double check. When we do our monthly review, I will look through and try and give you a better answer. PropNex hit target price, now close to 197, still good. The recent launches are still good. Will that boost next Q earnings? Okay, yeah. So my own view is about the news flow. So I don't think there'll be any positive news flow for now. The one that we hope for in very near term was like you mentioned, the Springleaf residence, because I think PropNex alone could have taken 80-90% of the launch themselves. So it was already mentioned by a lot of the agents that Springleaf residence would have been a very good launch. And that was the last positive piece of news I could get, because after that, you'll be hungry ghosts, then you won't see much news on property launch. Yeah. So from here to year end, my only worry for PropNex is just that there will be not much news flow. So the big news flow, I think, will be only at the November, December. Maybe you get when new launches come back again, you get the positive news. Then the big positive momentum for them will be when the year end comes. They will probably announce good results, and I won't be surprised if they announce another bonus issue. They tend to do it when the share price cross like $2 around these levels. Of course, bonus issue we know in theory doesn't really move the share price, but in reality, the last bonus issue they did, I think the share price really spiked up X bonus. So from here to November, December, I don't think there'll be any positive news flow. So that might kind of weaken the momentum in the share price. Yeah, I hope that answers it. So, but only in February next year when the results, because they do it, the release results every 6 months. So it's just that I'm worried of the news flow and Hungry Ghost Festival. Nobody said anything. Yeah. Any update on KNF? Yeah, I will give you more details because they didn't do a briefing. So I didn't want to preempt and give any comment. Yeah. So once the briefing is out, we will I will announce, we will write a note and then share with everyone. Yeah. Thanks for your patience. Hi, Paul. As both APAC Realty and PropNex are both near all-time high recently, which is a better buy with more upside moving forward? For us, we only cover PropNex, and because PropNex is the leader, we're almost 60% market share. So for us, and they have a cleaner balance sheet as all net cash, and they always have consistently tried to pay very high dividend yield, not just the dividend per se. They always mention, that they want to be the good dividend stock. So my assumption is probably 5 to 6% kind of yield. So that's why we always stuck to PropNex, and like any other market, you only buy the leader. You only buy NVIDIA. I don't think you're going to buy AMD for AI. Just to give an example. So that's why we only cover PropNex. Yeah. Okay, most presentation stocks report good earnings, while Boomi and First Resources share price respond positively, but Golden Agri is not. Why do you think so? Okay, I didn't have time to go through in very detail, but my belief is that because at least Golden Agri is impacted by refinery. So refinery business in Indonesia is actually quite bad. The margins are really weak and performing poorly because the availability of palm oil supply. Most of the palm oil supply right now actually goes to biodiesel because of the B40 and next year even B50. So because refineries need cheap palm oil, or at least a lot of availability, and then with all the supply being diverted to biodiesel, it hurts their margins. Not to mention, of course, globally, demand is also weak. So Golden Agri, if you compare the results, I think First Resources did better. Of course, there was an acquisition. And First Resources just expanded the biodiesel plant. So among all the plantation companies, I think our preferred pick has always been First Resources. The difference is that they are getting an additional new jump in biodiesel capacity. And secondly, they just made an acquisition, and there seems to be a lot of synergies on it. We'll do a Phillip on the ground next week, just that too many results this week, so I didn't have time. But our preference has always been First Resources amongst the three. Okay, let me answer one more before I have to go. Hi, Paul. Are you still positive on Sembcorp Industries? Your research say wait for payout. What is the payout? Okay. Yeah, thanks for reading our report, or at least reading the title. Yeah. So the payout I'm referring to is the renewables. So I won't be surprised if there is news that they might want to list their India receivables. They hinted at it. They weren't explicit, but that is my guess. So they want to monetize the usual sell the furniture thing. So they might want to monetize some of the India renewables, and also we won't be surprised if they raise the payout. The payout ratio now last year was I think 40 or 50%. So there's room to double the payout or double the dividends. So that's why what we meant by wait for the payout. So there's these two categories: the higher dividends and listing of the renewables. Okay. Sorry, let me just. Why is Sembcorp share still falling after fell so much? Yeah, I'm also surprised. The only one lingering thing apart from the disappointing results, there will be a one-off that they didn't mention in the prior. So I think the whole market got caught off guard. But the one thing that was negative was the renewables. So in the imported if you notice, to end of last year, they imported renewable energy from Malaysia. I think Tenaga, if I'm not mistaken, and for 2 years. And I don't think they are probably losing money on this because when you import, of course, you have to pay a certain price, then you have to on-sell it to the customer. But the customer may not be accepting the price because they may worry about the quality of the renewables coming from Malaysia. So although you say it's renewable, but they may not think it's renewable. I mean, right? So yeah, so I think they're losing money on that deal. So that was the only more permanent thing that came out from the results, that there's going to be losses from this renewable import. But apart from that, we think second half will still perform well because of the Senoko acquisition, and also renewables year on year will still do well because although seasonally it's weaker, but renewables, they still grew the renewables capacity by 20-30%, and they have another 50 to 60% of capacity that is being under construction. So I wouldn't be too worried about the second half results. Hopefully I'm right this time around. Yeah. And there's no more one-offs that they never tell anyone. That was a disappointment. Do you prefer Sembcorp or Keppel Corp fundamentally? For us, we always mention that we prefer Keppel Corp because we think Keppel Corp next year will be very strong. You get the double barrel push to the share price. They will monetize a lot more assets because they have a target by 2026. And also the other benefit is that operationally you're going to have a lot of assets performing. The submarine cable will be operational, the data center will be operational, and the new Keppel South Tower will also be operational. So the earnings operationally will also jump. So that's why between Sembcorp and Keppel, we always prefer Keppel. Okay, there's an iFast question. I think that one we probably have to leave it for Glenn to talk about it. Yeah, but off the cuff, we don't really have a strong answer for you. I think you have to wait for Glenn for the iFast. So I think we can't answer the iFast. Okay. After monetizing assets for Keppel, what is left in Keppel? Oh, okay. So after they sell the assets, it would be the whole data center value chain that we mentioned. Yeah, it is about the fund management business after that. They want to be like the Brookstone. Is it a Brook? Yeah, they want to be a pure asset manager to raise assets. So they will become just like I wouldn't say private equity, but they will operational like Brookfields. So they will be operational and also they can raise funds to build data centers. They can operate them, manage them, and so forth. Yeah. Well, of course, after the monetization, what you say is correct. After monetization, you won't get that additional monetization kicker to the share price. So that's absolutely true. Yeah, because there's only so much furniture you can sell in the house. Right? Yeah. Okay, I think I will leave it to Darren. Yeah, for the rest, I think I have to. Oh, sorry. What's the difference between Philip Morris e-cigarette and vaping? Oh, a lot of difference. Yeah, I think I better answer this one first. So e-cigarette is legal in the US. It's heating the cigarette. So you take it's actual cigarette, but instead of burning, you are heating it up. So apparently it's supposed to be better, inverted comma, compared to vaping. Vaping, you actually add chemicals. Yeah. Let me just clear that. So this is e-cigarette, it's not vaping. Yeah. So thanks for the clarification. Okay, thanks everyone. Hand it over to Darren.
Yeah, thanks, Paul. Yeah, let me just some. Do you think GoCoLand will continue to hit new highs? Any impetus on Springleaf? Yeah, so we believe there will be some momentum definitely in the share price from the good performance of Springleaf at 90% so. Yeah, but if you're asking whether it can hit new highs, and I think that one is more like a TA question. I leave it to Zane. If for next week, or if you want to know, you can type in the P3 as well. What's your thing outlook on GE? Do you expect any volume remain with them? What TP? Yeah, we don't cover GE. Fortunately, Glenn is also away, so I'll just wait for Glenn to be back to answer that. NTT D3 has gone below IPO price. Is it time to buy, and what is the dividend payout? When is the dividend payout rather? Yeah, so a dividend payout will be after the full year. That will be next year, the first dividend payout. Gone below IPO. Is it time to buy? Yeah, so like I mentioned previously also, there are some headwinds for NTT REIT. Like for instance, we believe that 7.5 dividend yield. There are some factors that went into that calculation. So first of all is that the management fees fully in units. So as a result, the dividend yield will be higher as well in the near term, but over a longer term it will be diluted. And also the fact that they don't, or rather they are paying 100% of their distributable income as compared to like Keppel DC, for instance, where the peer like data center pure play, they pay out about 92% ish, so they retain about 8 8% of their distributed income for capex reserves. So entity this REIT, they have not set that aside to get 7.5% based on IPO price. So I mean, there's as a result, I believe that's some of the reasons why the market has kind of factored in that their dividend will drop. So which was why also I think the share price is below IPO price now. Yeah, so yeah, I think that are some of the reasons. Yeah, so hope that answers the entity DC REIT question. And what's the impact of Keppel DC REIT selling of preference shares and the NECO bonds on the share price short to medium term? Yeah, so effectively these bonds, they every year they contribute about 11 million to Keppel DC's number, but the sale of this we don't think will be very significant, as ultimately Keppel DC's model is still based on the pure play data center, so more of operating data centers and such. So we believe this when they sell these preference shares and the NECO bonds, they will free up more capital to pursue inorganic growth like acquisitions and such. So we actually think this is a good thing. Yeah, so but basically the impact from that in the near term will more be like the absence of this income from these bonds, about 11 million annually. Yeah, who are considered the peers of CLI? Yeah, CLI does not really have any peers in Singapore because they're more of a very pure play fund management, and although they already moved their development arm to the CLD, so that's privately held. So yeah, that's a very challenging question. Who are considered peers? So it's not really the property developers also. So I don't think there are any comparable peers for CLI specifically per se in Singapore. Yeah, there are some others who strive to be a fund manager as well, but not really like a pure play like CLI. Yeah, like for instance, some other developers, they have a little bit of a fund management arm, but overall it's still they have their development arm also that is still inside the company. So yeah, it's not really comparable. Yeah, yeah. Yeah, I would say they don't really have any peers. You mentioned Liberation Day effect. Can you please explain how CLI affected by that? Yeah, so after the announcement and the tariff uncertainty, basically because CLI, a lot of their business is driven by divestments and as well as deployment of capital, as well as any transactions in their funds, listed fund platform and private equity funds as well that can generate a bit of performance fees. So because of this Liberation Day, a lot of these buyers, they were adopting a more wait and see approach to determine like what exactly is the outcome of all this uncertainty. So because of all this uncertainty, they basically just sitting on the cash. They're waiting, and for the first half of 2025, basically there was absence of a lot of these transactions. So we think going forward in the second half, a lot of these acquisitions and like investments and transactions should be pushed forward to the second half from lower interest rates. So that is like a backbone for transactions to return, as well as the pent up demand from the first half where a lot of transactions were just pushed back. Yeah, because of this uncertainty. Yeah, so that is what I meant by that. Current price, do you prefer CDL or UL fundamentally? Yeah, so CDL we don't cover. Yeah, CDL, I gave a presentation about that. The gearing is at 70%, but it's expected to come down when they use some of the divestment proceeds to pay down the gearing. It is high at 70%, but that's mainly because this quarter, so they bid for 3 GLS sites. So as a result, yeah, the gearing was high. Yeah, so that is the reason. industry price to NAV now. So it's roughly still around 50% discount to roughly price to NAV. Do you prefer AIM CPL or Ascendas fundamentally? Yeah, so both, even though they're industrial assets, they operate in I mean some similar geographies and some different geographies as well. Yeah, like for instance, Ascendas, like during the results briefing, they noted that the rest of the portfolio remains resilient, but there is a little bit of weakness in the US, like the US office space and the business park space. Yeah, so that one's a bit a downside, but generally, Ascendas is so big, is such a big REIT. The market cap is almost like more than 10 times of AIM's APAC REIT. So yeah, it's purely by scale. You can't really compare these two. Yeah. Yeah, but we don't cover both AIM's APAC and Ascendas. Yeah, but generally for industrial sector, we are expecting the rent to reversion to moderate after many years of double-digit growth. So probably in the mid-single digit rent to reversion outlook for both AIM's APAC and Ascendas as well. What's your view for Hong Kong market? Yeah, sorry, we don't cover Hong Kong. We do have our Hong Kong research. That's up here, but yeah, here in Singapore we don't cover Hong Kong, so we don't. Better not for us to give any take on the Hong Kong markets. Do you prefer CLI or Keppel Corp? Yeah, I think Paul mentioned we prefer Keppel Corp, but we also like CLI. So yeah, I believe both of those are in our absolute 10. Yeah, so we like both. Do you like Mapletree Lock or Mapletree Pan Asia more with China exposure? Yeah, so for Mapletree Lock, we see rental reversions improving in China, and as we believe within the next couple of quarters, the most of the Chinese leases will be ready mark to market. So after that, we think going forward the reversions might not be so bad as we've seen over the previous quarters, like double-digit negative, like in the negative teens rental reversions. So we do see some signs of recovery from Mapletree Lock. For Mapletree Pan Asia, we believe the overseas assets are both like in Japan, for instance, are seeing some challenges with like the master lessee just known vacates of the whole building. Yeah, so it's I believe slightly more challenging for Mapletree Pan Asia, but that said, Mapletree Pan Asia Singapore portfolio is very resilient, very strong, underpinned by VivoCity. Yeah. Oh, during my presentation, you mentioned about CLI's peers. Oh, yeah, not sure whether I said that. Maybe it was slip of a tongue. Yeah, but generally, yeah, CLI, yeah, because of the business that they're in, they are just a fund manager. Basically, they're a fund manager, and they are looking to divest more balance sheet assets as well. So, yeah, they do not really have any peers, and yeah, I believe Bloomberg still classifies them as developers, but they're not really a property developer. So yeah. Yeah, okay. There are still some questions. Let me hand it back. Yeah. Yeah, thanks.
Yeah, thanks, Darren. Yeah, I'll take on some remaining questions. One question for Franken. Any reason for the recent price drop? Yeah, I think similar to AEM, it may be because of investors' expectations. maybe because at the start of the year, uh, I think overall for semiconductor equipment space is very positive outlook. But however, I think in the most recent quarter itself, ASML, I think in general also for the semiconductor equipment companies, their guidance for this year and next year is very much muted. For example, ASML, they don't even want to provide guidance about 2026. So I think that's why for Frankel itself, management also became a bit more conservative in terms of their semiconductor segment. So I think in their outlook they stated that they became neutral. Yeah, but I feel that there will still be growth. It's just that I think management is trying to manage expectations a bit. Yeah. Mm. Overall, we are still positive on Franken. Yeah, because they have other segments to cushion this kind of maybe temporary slowdown. Yeah. There's a question. US government is taking stake in Intel. What's the impact on AEM, if any? Yeah. I think the news that US government is taking stake in Intel may not be a positive news. I think I'm quite neutral about it because I mean you look at Donald Trump's track record. He took out the CHIPS Act, which is previously subsidizes Intel's operations, and right now he also put taxes on Nvidia and AMD's sale of chips to China. So I think them taking a stake in Intel just means that maybe they want more revenue contribution or some taxes from Intel. And US government also don't have the technical know-hows as compared to TSMC and AMD. So even if they take a stake in Intel, they can't really provide the kind of uh, uh, intellectual capabilities for Intel to turn around their business. Yeah, because this kind of supply chain competitiveness takes years to build. And I don't think the US government has what it takes. Unless maybe they are able to get TSMC to take a stake in Intel, then that may be more positive for Intel. Yeah, so I think the impact on AEM is that it doesn't really change our view on AEM. Yeah, but we don't cover AEM. Yeah, it's just some insights. Yeah, hopefully it gives you some insight. Yeah. Yeah, what is the outlook on WeHer? Yeah, recently they released their results. Their earnings briefing will be this week. So hopefully next week I can give a better response to you. But for now, from what I can see, their results actually outperform our expectations. Um, I think for their PETME wise, there's a dip in PETME year on year because they recently sold off their Australia PBSA assets. And there's also some fair value losses and FX losses. But I think overall for next half itself, our outlook on WeHer is still positive because we do see their construction segment ramping up because of them winning the HDB BTO contracts. Yeah, so it takes a few months to prepare the equipment and so on and so forth. So we do think that second half of the year it'll start contributing to construction revenue. Second reason we are positive on WeHer is because uh their second worker accommodations, which is Pioneer Lodge with 11,000 beds. That one was just operational in June. So it didn't contribute much to the this half's earnings. So we do see second half earnings going up. And last but not least, we are also positive on WeHer because they have a remaining stake in the Australia PBSA assets. They have a 13% stake, and they are also establishing I mean they may be considering to sell Fund 2 and Fund 3. But the sale, I don't think it'll be in second half this year. It may come next year or the year after. Yeah. So that may be some catalyst going forward for WeHer. Yeah. But I think next week I'm able to give a better response to the earnings. Yeah. Yeah, I think that's all the questions I can answer for now. Yeah.
Yeah, thanks, Ivan. Let me answer this last few before we close. What's your view on Capital Land India Trust based on results going forward? Is it a better choice than China? Yeah, so generally, yes, definitely the India property market is doing way better than China. So, in addition, the performance for Capital Land India Trust also was very strong in the first half. We saw DPU growth, rental equivalence of 9%. DPU growth was also around that level also. Yeah, so generally we believe more core organic growth from Capital Land India Trust is there's more potential for that as compared to Capital Land China Trust where the business parts, logistics parts sees some weakness. Retail is also it's the best performer, but it's also not performing that well as well in terms of rental reversions wise. Yeah, so generally the India is performing better than China. Yeah, think that's all. Yes, reached 1 o'clock already. So thank you all for your time for attending this webinar and as usual for your support as well. Yeah, we do have some corporate insights webinars upcoming over the next few days. So please join us if you're available. And yeah, other than that, thanks again. Hope to see you next week.